Sorry, Ivan, I think you're on mute.
Sorry. Can you hear me now?
Yeah, now can.
Okay, sorry. Um, Welcome everyone to today's Phillip Securities Research Morning Call. Today we have a few stock counter updates. For results, we have BRC Asia. For updates, we have Centurion, City Developments, CapitaLand Investments, Zixin Group Holdings, Lendlease Global Commercial REIT. For Phillip on the ground, we have CosmoSteel and Uni Asia. We will end off the session with the usual Singapore SG Weekly week for week 49. And please also kindly note that the last morning call this year will be on next Monday. And kindly also note that Zane is on leave today, so there will be no TA session today. This is a disclaimer that the contents presented is solely for educational purposes and not financial advice. Moving on to BRC Asia's FY24 results. BRC Asia presented their released their FY24 results last week. For revenue, revenue has performed below expectations. It is around 90% of our estimates. And this is because there's an estimated 10% fall in steel prices, and also because of engineering delays, which has caused slower progress in the project completion. As for PATMI and adjusted PATMI, it is within our expectations. For PATMI, PATMI experienced a 24% year-on-year increase because of a one-off gain of 16.5 million, because of a disposal of an associate. Whereas for adjusted PATMI itself, it is almost flat year-on-year. For the positives for BRC Asia, they have a strong order book. Their order book is currently at $1.4 billion, and this is one of the highest amount recorded by the group, because the last time the order book exceeded $1.4 billion was in second quarter of last year. And they also have a higher dividends of 20 cents per share this year, as compared to 16 shares last year in FY23. And this is an increase of 25% year-on-year. And its normalized dividend payout ratio also increased 15% year-on-year, from 57% to 72% in FY24. As for negatives, we do see some revenue headwinds for BRC Asia. The first one is because its revenue is closely correlated with the steel rebar prices. And we believe that steel rebar prices can continue to fall around 10% in FY25 because of weak demand from China's construction sector. And we also see one of the other revenue headwind is engineering drawing delays, which this has been caused from construction incidents, such as the 2-week safety timeout in November this year. And this can also cause revenue growth to slow. Our outlook for BRC Asia is that we have lowered our FY25 revenue and PATMI forecast by 4%, as we think that the strong order book should boost revenue in FY25, but we expect it to be offset by the project delays as mentioned. And our call is to maintain accumulate with a higher target price of $2.80, previously $2.27. And the higher fair value is due to the lower net debt from lower inventory costs and cash from the disposal of associate. Next up, we have Centurion. Centurion, we hosted Centurion for our weekly corporate insights webinar, and one of the update is that there will be a new 1,650 bed purpose-built dormitory PBD to be operational starting from December this year. And because T5 construction will commence in the first half of next year, and because there is also a lower supply of PBD in the east of Singapore, we do expect a 5 to 10% higher rental rates to be charged for Westside Ubi PBD. And this PBD is located in the east of Singapore. For context, the 1,650 bed, it makes up about 4.7% of Centurion's total Singapore bed supply. However, we do see some headwinds for Centurion. Firstly is the dependency ratio ceiling, DRC. This has been reduced from 1 to 7 to 1 to 5 starting from January this year. What this means is that for every one local employee, an employer can only employ 5 work permit holders. Yeah, so this ratio has been reduced from the previously 1 to 7 to 1 to 5 currently. And this has caused the demand growth to decline in June's MOM data, as can be seen from the red line in the graph on the left. In December 2023, it was 6%. However, in June's data, it is 0.4%, close to zero already. Hence, we expect that rental rates in Singapore's purpose-built dormitory to moderate in FY25. The other headwind we see is the dormitory transition scheme, DTS. So this is a series of specifications implemented by MOM for worker dorm providers to meet. So there is an interim standards in 2030, and we expect that Centurion's bed count will reduce by 3 to 12% in order to meet these interim DTS requirements. This is because they have to do a bit of retrofitting here and there, and during the retrofitting process itself, the bed supply will decrease by a bit. For our outlook for Centurion, we believe that the boost in revenue and PATMI from the Westside OB PBD in FY25 will be offset by the revenue headwinds from the DRC and DTS as mentioned. And our call is to maintain accumulate with an unchanged target price of $1.02. Next up, we have CosmoSteel Holdings. For this one, we are doing a Phillip on the ground because we attended their FY24 results briefing. So CosmoSteel is a company which does sourcing, supplying, selling, and distributing steel piping systems. So the company's products include steel pipes, tubings, fittings, as well as steel tanks. Their revenue for FY24 declined year on year by 17%, and they also experienced a net loss of $5 million. This is management guided that this is mainly because of order book delays. So their current order book is $45 million, and they expected to deliver $30 million in FY24. But however, they didn't manage to deliver because of some delays, and this will spill over into the first half of 2025. They have also started shifting into the Malaysian warehouse in third quarter this year, and they are moving 70 to 80% of their inventory to Malaysia. This is because they want to cut costs, because the Singapore's factory experienced a $1 to $1.5 million depreciation cost per year. However, in Malaysia, it is freehold, so they want to move to Malaysia to cut down on this depreciation cost, and they also want to cut down on manpower costs because it is cheaper to hire factory workers there. Management also guided that for future revenue streams, they are looking for businesses with recurring nature. For example, they have started supplying plastic materials to Panasonic, and however, this will be subjected to investors' approval because one of the investor present also did raise concern about CosmoSteel not focusing on its core competency, diverting from steel to plastic. So this one will be pending for more to see whether the investors are agreeable on this approach by the management. Our outlook for CosmoSteel is that the first half revenue next year should be boosted by the 30 million order book delay from FY24. However, management did guide that for FY25, they will experience a significant net loss because of transport costs to Malaysia and also because of falling steel prices. Yep, that's all from my end. I'll hand over the time to Darren now. Thank you.
Yeah, thanks, Ipan. Yeah, so I'll run through City Development's the quarter operational update. So no financials were provided as per the usual 1Q, 3Q. They don't provide any operational, they won't provide any financials. So it's just an operational update. Yeah, so for this third quarter 2024, we saw that there was some strong sell-through rate for the development segment. So in the third quarter of 2024, the group had sold 321 units. So that came along with a total sales value of about 611 million. So in the third quarter 2023, which was the year ago, it sold 183 units with a total sales value of 325 billion. So that's about 325 million. So that's about double the sales value. So sales for this quarter was driven by the launch of the 276 unit Cassia in July, with about 65% of the total units already sold. So their other launches continues to do well. To date, Tembusu Grand and The Mist have sold 91% and 73% of the total units respectively. So the group, they also launched the 348 unit Norwood Grand in Champions Way in October to an overwhelming response. So we saw that over the launch weekend, they sold 84% of their units sold at an ASP of $2,067 PSF during the 366 unit luxury project Union Square Residences, which is located in the Prime District 1 at Havelock Road. So that also was launched in November. So right now, it is 26% sold at an ASP of about 3.2K PSF. So the sales for this project is still for luxury is still relatively weaker than the mass market developments because of the ABSD, that like 60% ABSD that basically all the foreign buyers have evaporated. So now going forward, the group plans to launch its JV project, the ORI, in first quarter 2025. Yeah, so the CDL, they're also replenishing their residential land bank in Shanghai for longer term growth. So they announced that they had a joint acquisition of a 28,000 square meter mixed use development site in Shanghai. So that's for about 9 billion renminbi, or about 118,000 square PSM, 180,000 renminbi per square meter per month, uh, per square meter with its partner Lianfa Group. So this is located in the core and mature Xintiandi area in Shanghai's Hangpu district. So this site has about 76,000 square meters. So about 77% of it will be used for residential and 19% for commercial properties and 4% for public amenities. Yeah, so this is despite a weakness in China, but tier 1 cities like Shanghai still remains promising due to their potential economic growth. So their hotel operations continue to remain resilient. So in 9 months 2024, their portfolio RevPAR grew by 2.7%. So now it's at $167. So this is driven by growth in Australia, Asia, following the acquisition of Sofitel Brisbane Central Hotel. So the group also has some AEI planned for several hotels upcoming, and this is to enhance the guest experience and also to improve occupancy. So for the negative for this operational update is that their net gearing remains high. It increased from 67% to 70%. This following the recent acquisitions. So this net gearing is based on fair value on investment properties. So the ICR right now is at 2.1 times, and they still have a strong liquidity position of about 2 billion in cash. So in the near term, there's no liquidity concerns, despite the fact that their gearing is relatively high at 70%. Yeah, so for the outlook, there's some early signs of improving property market conditions, with declining interest rates boosting buying sentiment and transaction activity, easing financial burdens. So Singapore's residential sales, we noted that in third quarter, it really ticked up. So this is mainly due to the lower or the favorable lower interest expense and lower interest rate environment. So going forward for the hospitality sector, the China's recent fiscal stimulus is expected to continue to bolster the discretionary spending, and this could possibly drive the travel demand from Chinese travelers, and as a result, the benefit worldwide hospitality segment with the increase in Chinese travelers. And also, the group is committed to capital recycling, so they have several divestments planned across diverse asset classes and geographies. Yeah, so with this business update, we maintain our buy call with an unchanged target price of $6.87. So this target price is a 45% discount to our RNAV of 12.50. Yeah, so that's all for city developments. I'll move on to CapitaLand Investments Investor Day. So just some very, very quick highlights on that. So for CLI, they mentioned that they want to double its FUM to 200 billion by 2028. So that is not new news, as they've mentioned that before. But the new news is that they'll also plan to double their operating earnings, operating PATMI, to over 1 billion by 2028 to 2030. So that is a new development for them. And they also plan to double their lodging management revenue to 500 million by FY28. So they've also mentioned that before. So the only new thing that they've said was the plan to double the operating PATMI too. to over 1 billion. So they'll do this uh, growth in the FUM and the FRB by expanding the REIT platform, also by accelerating the private funds growth and scaling lodging and commercial management through organic expansion, new listings, fund launches, and M&A activities. So these are improving all the 4 pillars in the FRB, the fee-related business. So there are more investor day highlights is that for their portfolio, they plan to achieve this 200 billion by rebalancing in some of the geographies. So this includes growing businesses in India and Southeast Asia and optimizing its portfolio in China mainly by reducing some of the Chinese exposure to a lower total weightage of the portfolio. And they also mentioned that they want to leverage M&As to expand in focus markets such as Japan, Korea, and Australia. And they're also looking at some ex-Asia developed markets like the US and Europe. And for their investment strategies, CLI adopts a thematic-driven investment strategy centered on 3 circular trends. So these are demographics, disruption, and digitalization. So for demographic shifts, so that includes the global aging and mobility. So these factors boost the demand for health span-focused living, wellness, lodging solutions, and also income-driven financial products. So basically, these will benefit the REITs and core investments. The disruptions from geopolitical uncertainties and macroeconomic shifts, these also create opportunities in private credit, special situations, and logistics and self-storage assets. As the global supply chains are remapped and there's some disruptions in the global supply chains. So the rapid adoption of generative AI and growing data storage needs. So all these will help the demand for the data centers. So basically, they're also looking at some increasing the data center exposure to support this growth or capitalize on this generative AI and growing data storage trends. Yeah, and they also mentioned that they do expect some weakness in China in the near term, especially from fair value losses and divestment losses. But we think that this might not be as significant as the FY 2023. FY 2023, they had a total of over 600 million of divestment and fair value losses and divestment losses in FY 2023. Yeah, so their ROE in China in 2023 was also negative at 8%. Yeah, so we think this weakness will likely continue in China. Yeah, so with that, no change in our TP, we maintain our buy call as well. CLI is now paying a 4.3% forward dividend yield, which we think is attractive considering it's not a REIT. Yep, that's all for me. I'll hand over time to Meow Meow. Thanks.
Yeah, thanks, Darren. Sorry, my camera is not working. I'll just present without it. So we visited Zixin factory and plantations in Liancheng Country, China. Overall, the investment into food security infrastructure by the government and also the company's R&D effort has driven up the volume and also shelf life of fresh sweet potato by 160% and 328% respectively in first half 25. And we identify some short-term catalysts for the stock during the trip, such as cold storage to boost fresh sweet potato production. The Liancheng government has allocated 120 million to establish cold storage warehouse buildings, offering a 4-year rental-free period for the warehouse operator. And this extends shelf life of fresh sweet potato from original 1 to 2 weeks to 1 to 2 months now. And with the higher selling price and also lower storage rate. So how it works is that the system uses temperature to accelerate the formulation of the scars on damaged sweet potato and thereby enhancing their durability and also preventing any existing sprouts from sprouting. And Zixin has also invested another 100 million in construct a new warehouse with research capabilities, aiming to expand its production capacity for processed sweet potato and also some functional products with higher margin to meet the rising demand. And the facility will primarily support original equipment manufacturer, which is OEM products, including supply to some like national brands such as Three Squirrels. And this is projected to increase the group's processed sweet potato capacity by around 20% in fourth quarter 25, which is this financial year, and additional 60% in first half 26. And also it's expected to double its production capacity by the end of 2026. And level 1 of the new manufacturing facility will be produce higher margin products, including some functional products like the single cell sweet potato powder, which is used in the confectionery industry. So this product has higher margin, it's around 30%. And for long-term catalyst, Zixin is broadening its revenue streams by transferring agricultural waste into raw materials of animal feed. And the limited waste collection within Liancheng country currently kept Zixin's production capacity at around 5,000 tons of the sweet potato animal feed per year. And to address this, Zixin is collaborating with the third-party companies to enhance waste collection effort, and expects the third party to double the collection and processing capacity by the end of 2025. And why Zixin is stepping into animal feed industry is that China is actively replacing soybean, which is a key component in the animal feed. Historically was heavily reliant on the import from the US. And Zixin is also integrating its proprietary probiotics formula into the animal feed to help eliminate residuals of hormones and also antibiotics in livestock, thereby improving meat quality. And with a higher margin of around 50%, we estimated Zixin is able to generate RMB 1.2 million in revenue from the animal feed segment in fourth quarter 25, and also scaling to around 10 million in 2026. And last but not least, Zixin is partnering with China's second largest company, which is City Construction, in Hainan Rejuvenation Project. And Zixin has invested 3.6 million, representing 3% stake in the project. And this project is expected to complete within 3 years. And following the completion of the primary land development projects, part of the land will be allocated for sweet potato cultivation. And the total cultivatable land for the sweet potato in Hainan is estimated to be 5 times larger than the current land in Liancheng. And Zixin plans to replicate the entire value chain from Liancheng country to Hainan. So with Hainan's more favorable climate condition, the region can support 2 years harvest compared to a single harvest in Liancheng. As a result, we expect harvest yield to double upon completion of the project. And Zixin is also implementing asset-light strategy, which with the majority of the fixed asset will be either undertaken by the government or the third party. So the group's revenue stream will be driven by sales of fresh and also processed sweet potato, seedling, and animal feed. So we maintain a buy recommendation with a higher target price of 0.056. Next slide, please. So here are some photos of our site visiting from 19th to 22nd November. On the left is cold storage facility in the warehouse. The third-party operator charges 800 RMB per ton, which is lower than the market rate of 1,200 RMB per ton. And after cold storage, all the sweet potato goes to washing and also sorting using the scanning machine. And the machine is able to detect whether the sweet potato is damaged inside. And next slide, please. So the photo on the left is the manual packaging work. A majority of the order in the warehouse is e-commerce order. And the second photo is animal feed. And the photo on the right corner is the new facility for the new warehouse, including vacuuming and also steaming. Next slide, please. Moving on to Lendlease. This is a model update. So although interest rate has already peaked, but we expect the all-in cost of borrowing for L rate will hover at around the current level, which is 3.7% in FY25. Yeah, which is this financial year. Yeah, this is due to the high proportion of the loans tied to the fixed rate, which will delay the benefit of any future interest rate cut for L rate. And meanwhile, Sky Complex Mainland is still taking longer than expected to backfill the vacant building, thus dragging down the portfolio occupancy down to around 75%. And we expect the building to be fully backfilled by the end of calendar year 2025, resulting in an income vacuum for financial year 2025. And gearing remained high at around 40.7% as of first quarter 25. And with the 360 million in bank loans and another 200 million in perpetual security maturing April 25, REIT has already initiated early discussion with the banks on the refinancing option. But right now we believe divestment is the most viable solution to address high gearing, and GEM office is well positioned for divestment. Given its very long list and also credible anchor tenant, which is the government tenant, Ministry of National Development. Yeah, so they also have an upcoming rental review in December 24. 2024. This is likely to boost the valuation, and we expect the selling price to at least align with the current book value. It's around 450 million, and the proceeds are, if the proceeds will be fully utilized to pay down the debt, we estimate the gearing would decrease by 8%. Yeah, so we still have a buy recommendation for L rate with a revised DDM target price of 0.76. Previously it was 0.8. Yeah, FY25 earnings are expected to be supported by the low teens retail rental reversion, with an upset from GEM office rental review, which we anticipate to be at least 5%. And DPU is likely to face another year of erosion due to higher for longer interest rate. Yeah, as the rate cut trajectory after Trump's presidency remain uncertain. Yeah, so we lower our FY25 26 DPU forecast by 10% and 5% respectively to 3.78 and 4.18 cents, reflecting a reduced expectation of 3 rate cut by the end of 2025. So L rate is trading at FY25 dividend yield of 6.6%. So that's all for me. I'll hand over to Paul.
Hi. Paul is currently in a SingPost call, so we will move on to Q&A first, and then after that, when he joins the call, then he'll take over from here. Yeah, so we can move on to Q&A. If you all have any questions, do post it into the Q&A, and we will take the questions first. In the meantime, while waiting for Paul. Yeah, thanks.
Yeah, hi, let me take the Capital DC question. Hi, Darren. Capital DC, if I remember correctly, is the theoretical X placement and X preferential offering price at 218. Thanks. Yeah, so the top is 218 if you consider if you use the VWAP of the preceding trading day before the announcement. Yeah, so you're correct. It's $2.18. That's the top. But the top, based on our share price, is $2.14. So now today is trading at $2.22. So yeah, our top and target price is below the current share price, which is why we also have a neutral price, neutral rating for that for Capital DC. For the SingPost questions, you have to wait for Paul. He's attending the SingPost briefing, so he'll be back with some insights in a bit. Yeah. Hi, Darren. What's the general outlook for S-REITs in 2025? Yeah, so for S-REITs in 2025, we think DPU, the potential for DPU growth is still likely. That's mainly because of the lower interest rates, the lower upcoming interest rates, even though originally we were anticipating about 5 5 more rate cuts until end of 2025. But since Trump's election, now we are only projecting about 3 until end 2025. So definitely the path of rate cuts will be the path for rate cuts will be slower. So that will affect the interest rate. So it will be the interest rates will just come down slower than originally expected. So that um is still positive on absolute terms, but if you compare it to previously, like when the expectations were 5 rate cut, definitely the S-REITs, there's some weakness in the share price because of the more restrictive monetary policy, which was why we saw some of or rather most of the S-REITs there. So the share prices corrected after the Trump's election. But moving into more of the individual subsectors, the outlook for S-REITs. So first of all, I'll talk about retail. For retail, we think the potential for positive rent reversions is still very strong. We've seen demand from overseas retailers coming, new F&B concepts as well. And the big thing for retail is that there's a lot of support for higher rental reversions because of the fact that occupancy cost is still much lower than historical averages. Because on average, for suburban malls, the tenant sales are about 20% above pre-COVID levels. For downtown malls, it's flattish to some are down, but overall, because of the low occupancy cost, we think that there's still potential for low teens to high single-digit positive rent reversion for retail. Yeah, so that's for the hospitality. That's for retail. For the hospitality sector, we used to be overweight, but now we drop it to neutral because mainly in Singapore, we noticed that there's a little bit of down trading. Like people or tourists are not spending at the luxury hotels. They're more price conscious. So the mid-tier to upper scale hotels are those who benefit. And overall, as the RevPAR growth, we think it will be slow from the increasing international visitor arrivals. So that is still increasing, but the fact that they are just spending less, but overall, with the proven occupancy, we think that RevPAR there's still potential to grow. And for Singapore specifically, there's also is the international visitor arrivals is very heavily based on the events that are held in Singapore as compared to many other countries. Because after all, in Singapore, we are so small there isn't I mean as compared to other countries, there isn't much to do if there is no events going on. There's like USS, which there's a plus as the Minion Land is coming completing next year. The Minion Land in USS, as well as the expansion of the Singapore Oceanarium, which is previously known as the Sea Aquarium. So these are some positives that can drive the RevPAR growth. But the thing is, next year there'll be an absence of major concerts, major events like Coldplay, Taylor Swift, Ed Sheeran, which were in Singapore earlier this year. So going forward, we think first Q might be challenging, but as Minion Land and the Sea Oceanarium complete, we think things might pick up towards the second half or the later part of 2025. So first quarter, we think there will be a little bit of weakness there. And we also noticed that the average length of stay has also fallen. So it used to be about 3.5 to about 4 days, but now it's fallen to 3 days only for the average length of stay. So basically, even though the visitor arrivals are improving, the length of stay has really fallen. So these are some weaknesses we see in the Singapore market, which is why overall, considering all these factors, we think we still expect a low single-digit RevPAR growth in 2025. So that is really slowed from the triple or double-digit growth seen in 2023 and 2024. So we saw some mid-single-digit growth in the RevPAR. So for the office sector for S-REITs, generally for Singapore office, the rents for a lot of these office REITs, they're under rented, which means that their passing rents are still below market rents. So as a result, we think there still might be some potential for positive rent reversions in the single-digit level. Yeah, but the new supply from IOI Central Boulevard right now that's the main issue because there's a lot of supply coming from that 1 million square foot. So that has been well absorbed. Right now it's 60% pre-committed, and according to listing agents, we're expecting that to be about 80% filled by the end of the year. But the thing is that a lot of the REITs with their office assets, they are not really targeting the very high end like IOI Central Boulevard is. So IOI Central Boulevard, they are targeting higher end tenants with rents about upwards of $14 per square foot per month. So with that also, it's kind of targeting different tenant base. So we think office overall, if you don't consider the fact that the office rent REITs still have some their rents being under rented, we think overall the fact that there will be an increase in vacancy because of the higher supply incoming as well as Keppel South Central. So we think overall the office grade rents will remain stagnant or even start coming down from 11.95. So in the third quarter it was 11.95 per square foot per month. Yeah, for Keppel South Central there is about 614,000 square foot that's incoming as well. So we think that basically supply will outstrip demand, and as a result, the rents will be affected and vacancies will increase. But just speaking on the REITs perspective, because of the fact that their passing rents are below market rents, there is still some potential for positive rent reversions. Yeah, so for more of the industrial, you notice that rent have really moderated from the double-digit positive rent reversion seen over the past few quarters, and especially since COVID-19 that time. Rents have risen about prime logistic rents have risen about 43% since then. So that is really a high number. And we also noted that a lot of 3PLs and e-commerce firms, they continue to consolidate, and as a result, there might be some or rather landlords that are focusing more on trying to fill up their logistic assets due to a lot of incoming supply as well, rather than trying to get some higher rent reversions for the sector. So going forward for logistics, we expect single-digit positive rent reversions. For business parks, there's still some weakness. Vacancies are still about 20%. So that's mainly driven by cost-saving measures and a lack of demand for business parks as well. So that will affect rental reversions. But the plus is that for data centers is still strong, especially in Singapore. We saw Keppel DC, they had some very strong rental reversions for their Singapore co-location assets, 40%, and we think that might continue going forward. But the strength is mainly in Singapore because of the limited supply and the very strong demand. For industrial, the weakness in China still remains for the logistics market. So that will likely remain for the next couple of quarters with a new supply entering and increased tenant incentives. So we are still expecting double-digit negative rent reversions for China. Yeah, so that is a very long answer for the outlook for REITs. Yeah, hope that answers that. So overall, we are more positive on retail because of the potential for higher rent reversions. But basically, all REITs, that the things to look out for is, if you are picking specific REITs, the percentage of interest rates, or rather percentage of loans that are hedged to fixed rates. Because if that is lower, they'll benefit faster from lower interest rates, as well as the hedge tenure of the rates, the hedge tenure of the fixed rate loans, as and also whether the REITs, they have already repriced their hedges to the higher rate. So for instance, if some REITs they've not repriced yet, then you should still expect rates to increase for them. Like for instance, if they fixed their rate like three years ago, and they're still paying that low 1 or 2% interest rate. So when that expires, you're expecting the interest rate to shoot up as well. So these are some of the things to look out for when you pick a REIT. Why don't City Dev pile down their debt? They have 2 billion sitting around. It's a debt is reflecting the share price. Yeah, so CityDev, they like to keep, usually historically they like to keep between 2 to 4 billion of cash in their balance sheet. So that is mainly for liquidity purposes, I would think. So yeah, yeah. So that's the reason, mainly for liquidity purposes and keeping opportunities for acquisitions as well. Yeah, so that's the, the key reason why I think they usually have around 2 to 4 billion of cash that's always sitting on in their balance sheet. But had that having said that, those are also interest bearing, so they are definitely earning interest on those, and they're just not sitting around and being idle. US stocks, leave that to Helena. What are your top three picks on REITs? Seems like every segment is like us except data center. Yeah, so right now our top three picks, we like Cromwell. Um, inside our REIT monthly, we did have some top picks. Our top picks are Cromwell REIT, OE REIT, and CapitaLand Escort Trust. So a lot of the for Class and OE is because the share price is still quite low and still trading below their NAV, and we think there's some potential for recovery. And for Cromwell European REIT, basically they continue to benefit from the lower interest expense, and also their capital management is very strong, and they are paying a high dividend yield of 8%. So that's why we think that's attractive. Um, yeah, I think Paul just joined. Paul, you there?
Yeah,
Yeah,
sorry.
okay.
Yeah,
Yeah,
sorry. Just
yeah. Thanks for then. You ready? To hand over to you for for your slides.
yeah, okay, yeah.
Okay, thanks.
Mm. Yeah, any very short slides for me because I was away most of the week. But anyway, thanks. Sorry for coming in late. I was in the Sing post briefing. So anyway, just a quick update on our weekly views. Next slide. So in terms of some of the data points that we had was in Singapore, we have some RevPAR number. This is essentially the hotel sales or hotel room sales, if you like. So that has I think returned to a growth again in October, maybe partly helped by the Golden Week by China. But it was supported by a 2% rise in room rates and also increased occupancy. So it was both factors that helped pushed up RevPAR. Now move on to the US, the very important inflation data, which is the core PCE. So that is within expectations, but it's still high, and we still think it's going to run hot the next few months. Uh, but that's because a year ago the numbers was actually exceptionally soft. I think quarter on quarter. But it's still running ahead of the Fed expectation. So it's still up in the air whether the Fed will cut the cut rates in the upcoming I think 16 December meeting. Our base case is still a rate cut, but I think the market is factoring a 50-50. Yeah. For trade balance, it's just a reminder that the US continues to incur very huge trade deficits, about 100 billion a month. So like you're talking about almost 1.2 trillion of deficit a year. And I think the good thing is that US is still the biggest growth driver globally. They're the biggest importer. So this is actually the fourth highest month they actually have a deficit. So I mean, there is room. So it only encourages, I think, Trump to impose all these tariffs because the trade deficit in the US continues to balloon. Next slide. So in terms of the tactical views, I think we got a glimpse of the new administration, although Trump is not in yet until the 20th of Jan, but we can clearly see there will be arbitrary and random kind of political tools used as a tariff. So he's basically asking Canada and Mexico to solve the US drug and immigration problems. But I think ASEAN is not immune to it. So even before Trump, you did have Biden imposing tariffs on Malaysia and Vietnam for solar export multiple equities are going to get hit too, especially the electronics. So for us, we think Chinese equities is the contrarian bet. So why we say that is that, firstly, tariffs is not just on China. So now tariffs is on Canada, Mexico, and almost everyone else. So although the crowded trade is that China will be hit by tariffs, but we think if you assume, again, these are all assumptions, it's trying to read, almost like reading Trump's mind. But if you assume Trump is transactional, and so there is a chance for Chinese equities to be a contrarian bet in 2025. So because if you recall, during his first administration, he did had a trade deal with China under the so-called Phase 1 trade deal. And because of that trade deal, he actually lowered China's tariffs by 50%. And the one other thing that I guess China doesn't have in compared to the first administration under Trump is that there's a Elon Musk wildcard, because Elon Musk obviously has auto interest and also potentially satellite interest that he wants to work out in China. So that could be the wildcard that could be in China's favor. So I guess the key message here is just not to be overly negative on China equities. If there is a major sell down, there could be a contrarian bet. The other thing is just that even before Trump really getting a rise in geopolitics, I guess this is even more dangerous, because if you missed the news, I think Russia announced a state of war declaration from special military ops. So this is a very dangerous escalation. And but I think when Trump comes, I think as we all know, he's mentioned that he would resolve the Ukraine war in 24 hours. And if that really happens, I think this will be positive on European equities and of course European currencies. And the one that will benefit will be the positive Commonwealth European REIT. So that will be the main beneficiary if you get some resolution out of Ukraine. In terms of the events to watch next week, the key one will be the US payrolls. So this will probably be the final data point before the Fed decides. Of course, there's one more inflation number coming up, but this will be one of the key data points before the Fed will decide whether to cut interest rates in the 16 December Fed meeting. Tomorrow we have a Marco Polo Marine webinar. No, feel free to dial in, open for everyone. And there's another Qantas thing which I'm not familiar what actually it does. Next slide. Just one last two slides for me. Just to show you the inflation number. So the shaded line is the upcoming month. So we will notice that there's a jump in the red line because last year was exceptionally low. So if you trend line now, I mean, this is not even a forecast. This is just if you trend line what has happened the last 3 months. We think inflation will still be running hot in the fourth quarter, but it will start to come down sharply in the first quarter of 25. This is just to show that gasoline prices is actually helping push down inflation, which is the blue line. So gasoline price is actually continues to come down, and this is a positive for inflation and room for Fed to at least ease. Next slide. This is our Phillip on the ground. This is just my last slide. So Phillip on the ground on Uni Asia. So for those who may not know, so Uni Asia, they had an analyst briefing. They actually mini a dry bulk carrier. Dry bulk carries grains, iron ore. These are the main codes. Basically anything that cannot be containerized, you use it as a dry bulk. They also have property development in Japan and also Hong Kong office investments. They didn't give much details, but this is just the chart on the left of where the dry bulk index is. It's actually recovering. I think it's up maybe in mid-teens compared to last year. So it's basically been stable this year. And one of the reasons is supply is very constrained for dry bulk because of slow steaming. Because in order to meet the IMO rules, a lot of the vessels are actually slowing down. And also yard capacity, most of the yards are busy building tankers, chemical tankers, or even containers. So nobody wants to build a small like 30 million handy-sized dry bulks. So for this company, I think they're looking to sell 3 of the vessels. They have 8. They might sell 3. Part of it, they're probably going to keep the money to actually maintain the dividends, and they'll probably acquire 2 large ones from the joint venture. They're still involved in the Alero. These are small condo blocks that they will buy and lease. Hong Kong has been a problem for them. So their model in Hong Kong was they actually they have like a 3-4% stake in a property office block, and then there will be sold for strata. So they put in $30 million. They written off 13. We think they're probably going to write off more because the conditions in Hong Kong office is not improving. Just to give you a flavor, they launched office building in April 23 and only 33% sold, 1/3. After 4.5 years, almost 3.5 years, it's only 1/3 sold. But thankfully, these are all non-recourse loans, so the banks are not calling because the banks also be stuck, as I said. So I think what they're going to do is just going to take some and try to maintain an attractive dividend yield. Okay, I think that's it for me. Sorry, it's pretty short for me today. Yeah, thanks. Move on to Q&A.
Hi, I'll take the Zixin question. Can you repeat how to extend the shelf life of sweet potato? Yeah, so basically, sweet potato will have longer shelf life once it has less sprouts, less damages, and also less water concentration on the skin. Yeah, so cold storage facility, it's not the traditional fridge. I think they do have some like certain IP, and then there's only like less than 10 companies has it in China. And yeah, so the cold storage will adjust the temperature to accelerate the formulation of the scars on the damaged sweet potato. And also with the high temperature, it kills the existing sprouts, and also it facilitates a process called post-sugarization process. Yeah, that reduce the skin's tenderness and also the water concentration on the skin. Yeah. So that makes sweet potato less susceptible, more susceptible to scarring. Yeah, thus prevent spoilage. Yeah, hope it answers your question. And for Lendlease, do you think that it is beneficial to sell the office asset at GM from a short-term versus long-term perspective, in the view that there is not many Singapore office asset for acquisition? Yeah, so definitely there will be some income gap in the long term once they divest GM asset. Yeah, but short-term wise, like DPU would be benefited from the lower financing cost. Yeah, since their interest rate will be higher for longer next financial year or this financial year. And if ILREIT sell GEM office, Parkway Parade would be the next target for acquisition. Yeah, since they already own around like 7% of the stake in Parkway Parade. Yeah, but according to our knowledge, one of the majority shareholder, yeah, is pretty reluctant to sell more stake in Parkway Parade. Yeah, but ILREIT is actively working on it. And indeed, like there will be DPU, there will be some impact on DPU in the long term. Yeah, but having said that, their sponsor do have a very strong pipeline. There's like 121 billion pipeline across Australia, Singapore, and also Italy. Yeah, hope it answers your question. And there's a question for Suntec REIT. Yeah, so outlook for Suntec REIT will be pretty muted. Yeah, and cause there's like less mass event, and the corporate is also taking longer to book the event for their corporate event in Suntec Convention Center. Yeah, so we don't expect any like income surprise from Suntec Convention Center next year anymore. And also like rental reversion for both retail and office will be around like high single digit. And there's like less room for Suntec REIT to push the rent higher, given the occupancy cost is already at around like low 20%. Yeah, and not to mention that income supply there'll be a lot of upcoming supply for the office market next year. Yeah, and also all the low rents they signed during COVID period has already been flushed out. Yeah, so rental reversion next year will be like lower compared to this year. And also marketing Australia is pretty weak. Yeah, since there's a lot of upcoming supply for the office area. And also like incentives are elevating. And UK said it's still taking longer for Suntec REIT to backfill all the vacant building. Yeah, so there will be some income gap from there. And the only positive side for Suntec REIT would be their interest expense. Yeah, given there's like, given they have very low hedging of around 58%, yeah, which is the second lowest among S REIT. Yeah, we do expect Suntec REIT to be one of the first REIT to be benefited from the more aggressive rate cut in 2025. Yeah, that's all for me. I'll hand over to Paul. Thank you.
Yeah, thanks. Thanks, Memo. Yeah, sorry, I did not turn off my. Oh yeah, okay. Singpost is selling their profitable Australian business. Then what is there going forward? Okay, they were very reluctant to talk about what is the. Yeah, thanks for the question, SKT. So I think everyone asked a question. I also asked. I think there were probably like 5-6 questions on this. Like, what are they going to do next? So they really can't give an answer. They said they cannot give an answer to that because they have to complete the sale, then look at the review. But Australia, to me, is a bit of a bittersweet news for me because I thought because Australia was supposed to be their core business. Australia was supposed to have the synergy because the game plan for Australia was to have a 4PL. 4PL basically that they're like a arranger of logistics. Then you have courier please, which is the last mile. Then you have warehouses and so forth, all coming into the business. And so Border Express and so forth. But I think I guess when you have maybe Singtel as part of the board and Singtel's on the monetization path, they decided to sell. So I mean, it's not clear what they're going to have. But in general, it's still positive for the share price because with this, they are very high chance they will pay out a special dividend. Then even then, there's still a $1 billion $1 billion Singpost Center mall on their balance sheet. Because after this transaction, they are almost close to net cash. And then Singpost Center is about another billion there. So, but of course, after that, you're just stripping down to nothing left. So in the end, they end up being just a Singpost poster business. Yeah, which is, I don't think this is the management's intention. They did such a challenge, took them such a difficult effort to acquire all this business to pivot away from Singapore Post. Now they have to pivot back into Singapore Post. Yeah, but in the near term, I think the share price should still be positive because there's still the Singpost Center to sell. The next only be a positive thing for Singpost. Yeah, but anyway, just to go back to the answer, they didn't want to give. They said they can't give. They've not decided yet. Yeah, in a way. Hi Paul, what's your implication of the Singapore stock market when the SG 10-year yield falls below 2-year again? Which sector should benefit, lose, or? Okay, so you're referring to yield curve inversion. So basically, yield curve inversion is at the margin will be negative for the banks in general. Because banks benefit when the yield curve is sloping. So what it means that they take deposits, short-term deposits, or all the CASA, maybe 1-2%, and usually the 10-year bond yield is higher. I mean, just give an example. Then they can collect deposits at 1 year, then park the money at 10 years, which maybe 2-3%, then they can make more money. But in general, the banks and of course, usually when there's a yield curve inversion, it's also another sign that the economy is slowing down in general. Yeah, but I guess this is an inversion question. Yeah. Will China real estate story mimicking Japanese property slump in the early years from info gotten since very dire on this? Yeah, you are right. I think at the peak, I think in 2021, China was selling almost 15 million homes a year. This is our own estimate because you have to use the space and average it out. Right now, they're selling at 7 million. So it's like half. And you all know, like the debt has, I don't have the numbers in front of me, but there's a major, similar to China, there's a balance sheet recession. So even though interest rates are at all-time lows in China, or if not 20-30-year lows, a lot of households are deleveraging, corporates are deleveraging. If you look at the loans growth, so the amount of loans, I don't have the chart in front of me, but the loans continue to come down. So it's very similar to Japan in the sense because they are deleveraging. That means what it means that even though interest rates are low, they rather pay down the debt than try and gear up. Yeah. So I think if you all saw the news, there was I think 50-year bond by China at 2%, if I'm not mistaken, and everybody rushed for it. So there's clearly deleveraging. And when you speak to some developers, they'll tell you the households now are more worried about their jobs than going to buy a property, and they rather focus on servicing their existing jobs. The opportunity, I think, speaking to another property company, is actually rental housing in China, because although prices have come down, they are still very high, and that's why I think something like what Centurion is doing, rental housing, because there's so much stock there, so the property price is low, but it's still quite unaffordable for a lot of the young. So a lot of them are moving into, I think, like Keppel, they're moving into rental housing in China too. Yeah, okay, I know there's a long answer. Yeah. This Google, thank you for your response. Tell me how many weeks you guys leave it on the website. Oh, okay, yeah. Most of our, if you're talking about our webinars, Mr. Alex Lee, most of our webinars are in the YouTube channel, so we leave it there indefinitely. Yeah, it's on the YouTube channel, PhillipCapital YouTube channel. Yeah. Okay, hi Paul, latest opinion on Yoma strategic. Yeah, share price. We never had a rated view on it. So, but for Yoma, the currency just collapsed 50%. If you check the latest note that we wrote, the problem is the debt. So if you think of Yoma as a property company, just generally, don't talk about the country risk. Even developers in Singapore are trading at 0.5 times book. So although they're not totally a developer, so what should a developer in Myanmar trade? So I think we'll leave it to investors to decide on that. But the thing is, essentially, this is just all about politics. So the thing to watch out for is really if they can get an election on. So that's the real benchmark to watch. Because this is nothing to do with about the business. I mean, they are really good. They're probably the best, one of the best conglomerates out there. So the key thing to watch is just geopolitics, whether there'll be an election. Even though the election, we all probably know the outcome even before it started, but with the election, it will give some legitimacy. And the most recent news has been very rare, but it's that actually China actually asked Myanmar to hold an election, which I think is one of the most strangest things to hear. A communist country asks another country, can you do an election? So anyway, the reason to do an election is just to give some legitimacy. And when you get that legitimacy, some of the Asian investors can actually come into your country and FDI. I mean, that's the general view. So yeah, without any resolution on geopolitics, I think it's a very challenging environment. But if you read the recent note, I think their currency collapsed. So they don't tag their currency to the official rates. They tag it to the board rates, which is what the bank rate is, which is actually the better way to trade, because that's, I guess, the real rate rather than the official rate. Yeah. Yeah. Any thanks for the question. Yeah. Capital infrastructure. Okay, we don't really look at capital infrastructure for me, but maybe Darren can help. For venture, for us, on venture, nothing really new. For me, I think it looks interesting because they are paying like a 6% yield right now, dividend yield right now at this price. So and then you just get a 6% yield and just wait for some of the customers to come back on. I think that's the only thing I can say, because I think the outlook is still very sluggish. I don't think the earnings will decline sharply. We are looking at maybe a low single digit kind of growth at best for them. And yet it's just like a yield stock on electronics, which is a bit of a hard thing to say because you buy electronics for growth. But anyway, this is our general view. Okay, the other one is if Google as antitrust comes to worst case and they have to split, how would that affect revenue? Yeah, actually, if there is a split antitrust, in a way, it could be a positive too, because by splitting, you can get some valuations of Google, actually, YouTube, sorry. So I don't cover Google. I think we are in the transition because our analysts, Jonathan and Ambrish has left, so we are in transition of an analyst. But if the worst case, I would have thought it would be positive. Actually, the one that could be negative could be Apple, because Apple is the one that's collecting I think, if I don't have the exact number, maybe 4 billion, I'm not sure, even 10 billion a year of payment from Google. Business it to pay off debt, to pay special dividend, pay for drag along procedures, etc., left with almost nothing. So why is management doing this? I don't think this is my own view is that I don't think this is what the CEO wanted, because the CEO was the one that pivoted into Australian business. But he doesn't own the company. The company is partly owned by who? Yeah, Mr. T, the owner of is of course is majority shareholder is Singtel, but of course there's another owner above Singtel. And everyone is on this monetization path. I would have preferred they just sell Singapore Center, then at least because there was supposed to be synergies from Australia. Although Australia near term would have been weak, but they were the fourth largest logistic player. So to me, it's a bit of a bittersweet thing. I mean, it's a positive near term, I guess. No, you sell furniture, you sell everything, but for me, I would have preferred they keep the Australia business and just sell Singapore, which was a good enough monetization to appease the existing shareholders. I mean, just my own view, but I agree with you. I mean, I think it's just a monetization. I think all the GRCs are in this major monetization sell furniture thing. Okay, I don't see any questions from my side. Darren, you want to?
Yeah, thanks, Paul. There's one question in the chat. What Phyllis asked, what happens when investors fail to sell CapitaLand REIT? What's your advice to them? Yeah, thanks CJ for the reply. Actually you can sell now. So what I'm guessing you're trying to ask is what should investors do if you are already entitled to the preferential offering, but you want to sell? Is it like there's a follow-up. What last day to sell? What investors keep the shares? Yeah, okay. So I'm not quite sure what you mean, because the shares are not halted and you still can sell anytime you want. But from what I see is today is the preferential offering registration, rather the opening date. So you can start applying for the rights. But let's say if you sell today and you do not apply for the rights, basically you'll still be entitled to the preferential offering shares. So if you do subscribe to that and if you sell it today, basically you end up with some your entitlement, which is, if I remember correctly, is 89 to 1,000 shares. So you have odd lots there. So that is quite a hassle trying to sell the odd lots. Yeah, so let me just refresh some of the dates. So for Capital DC, basically today until next week, 10th December, Tuesday, is the last date for the acceptance of the preferential offering. So from now to then, you can apply, and as a result, the listing and trading of the preferential offering new units will be on the 18th December. Yeah, so the private placement shares have already started trading. That was last week on 28 November, Thursday. And yeah, even if you sell your shares today, what I'm trying to say is that you still will be entitled to the preferential offering because it has already went XPO. Yeah, hope that helps. So what's my advice to if basically we have a $2.14 target price. So right now the price is $2.23. Yeah, so that is our call. Our call is a target price of $2.14. So which means yep.
Yeah, our view is basically just to sell it, because I think like we mentioned last week, right, Darren, there's a lot of shares coming out. So
Yeah.
there's the preferential shares coming out, there's the placement shares coming out. So our view is just to, just sell it, especially it's coming to year end. And fund managers might want to also lock in some of the profits. So our general view is just sell it now. There's a bit of a share overhang. After this acquisition, I don't think because this stock has always been low yield and growth is by acquisitions. So after having done this acquisition, I don't think you're going to see any new acquisitions in the near term. So for our general view is just to sell it.
Yep. Thanks, Paul. Okay, moving on. Hi. The view to China market for CDL and CPI are totally different. How do you comment that? Yeah, so actually, CDL, they are investing to this joint acquisition for this property in the residential land bank in Shanghai. And basically it's not they believe that in the long term they cannot exit China totally as well. So they are looking at some opportunities, and they believe in the longer term, even though now the China market is still very weak, they're still in the longer term, uh, tier one cities are still promising because of their potential for future economic growth, even though currently it's still not so great. Yeah, but this is more of a longer term play rather than a near term. Yeah, just in case when the property market picks up in the future, then they have some projects there as well. Yeah, so yeah, their stance is that they should not exit China completely. Yeah, so that's for the CDL. Digital Core REIT is acquiring 40% up to 40% of Frankfurt data center. How will they fund this acquisition? Yeah, so it can be a mix of they come out to say it can be a mix of equity and debt. So actually they came out with a table because they've not mentioned how many percent they want to acquire, right? So if they they come out with this table, if they acquire 10%, it will be done fully by debt. Because right now their gearing is at 35%, so they still have about almost 100 million of debt headroom. Yeah, so they can fully fund it by debt if they acquire 10%, but if they acquire 40%, which comes with a purchase consideration of about 188 million, so that definitely will have to come with an equity fundraising. Yeah. Any chances of making the moves as DC by issuing preferential shares or right issue to retail investors? Yeah. So let's say if they the end result is they acquire upwards of 10%, especially if they acquire the full 40%, then definitely they will have to raise equity. Yeah, so it will be something could be similar to DC. They could raise some private placements or even do some preferential or rights issue as well. Yeah, so that is likely if they acquire more than 40%. But if it's 10%, they've come up to say that it will be fully debt funded. Yeah, because they still have some debt headroom and their gearing is at 35%. Yeah, with the slower drop in interest rates, are there any REITs you cover with a lot to refinance in 2025 and will be affected? Yeah, so off the top of my head, I can think of is Cromwell. So we have Cromwell is still our top pick. We've already factored in the fact that they have a 450 million euro bond, rather loan that is expiring next year in November 2025. We've already factored that into our numbers, and despite that, Cromwell is still paying a dividend yield of upwards of 8%. So we think that's attractive. Yeah, so as a result of this refinancing, their cost of debt is about 3% now. We expect it to rise to upwards of 4% next year after they refinance this loan. So now their strategy is to wait until more rate cuts come, and when they do refinance this bond with a new bond issuance, so hopefully they can get a better rate. And yeah, the better rate of course, the better rate they get, the better for Cromwell. Okay, yeah, so that's that. If Capital Street seems to be overvalued now, what's the next best data center REIT to buy? Yeah, so the only pure play data center REITs in Singapore are DC and Digital Core. So it's either these two. Yeah, yeah, but we don't cover Digital Core, so I can recommend recommend that. How do you see the future data center business? Competition is rapidly increasing in Malaysia, US. How will Singapore be affected? Yeah, so for Singapore, especially the co-location assets, will remain very resilient because because of the limited supply and very strong demand still. And basically data centers, they are still limited by the amount of power that they can secure. So they can secure more power, basically that will help to benefit them. Like they can support like higher workloads and generative AI and such. So yeah, it really depends on the amount of power that the data centers can secure. Yeah, but for Singapore, we think that the rent reversions for Singapore co-location assets will remain strong. Possibly even maintain the 40% level that we see in Capital DC renew several of their major contracts at already. Yeah. Mm, yeah, for KIT, I'm also not so familiar. I don't really follow them, so I can't really comment as well. And then Cromwell seemed a right pick now. What is the risk of owning this REIT in the future? Yeah, so for Cromwell REIT, basically the risk is of course, it's definitely the major overhang is the refinancing of this new bond issuance. So in the near term, they've already secured something like a backup facility just in case that basically it's a facility or RCF that if they are unable to refinance, which is unlikely, or rather unable to issue a loan, then they can tap on this facility to pay off the existing loan or rather the existing bond. But that is unlikely, and that facility will basically fall off once the bond has been reissued or a new bond has been reissued. So basically they are really very secure already in that perspective or in that sense. Like there's no liquidity issues for that the particular refinancing of the loan. So going forward, we will start looking at rental reversions. So currently their portfolio is still about 7% under rented. So it is still likely that they can get some positive rent reversions, as well as the fact that most of their leases, or rather more than 75% of their leases are tagged to CPI. In fact, the majority are tagged to CPI, but to a varying degree. So most of it is 100%. Yeah, so they will benefit from all of these. How is the financial health of Mapletree Pan Asia? The share price shows investor nervousness, and I was wondering if it's a buy now. Yeah, so for MPAC, the Singapore portfolio remains strong, but their overseas assets, like every other country that they are in, saw some weakness in the most recent full year, like especially the Japanese properties, Makuhari sub-market, where there were some major tenants that are not renewing. And in the past, there's also one that left already. So as a result, we saw some huge valuation declines. So that is the overhang. There's some overhang in the Mapletree Pan Asia Commercial Trust because of those factors, like weakness in the other markets. But for Singapore, their portfolio is very resilient, and still the fundamental, basically their core assets are still very strong. For Mapletree Industrial, it could be a good alternative to Capital DC, but the fact that for Mapletree Industrial, most of their data centers are more centralized in the North American region. So for North America, we've seen data center reversions not as strong as Singapore. So around the single digit levels, high single digit to the low teen levels. And there's also some like AT&T is also have some issues, and they will not be renewing some of their leases as well, I think. Yeah, so yeah, it's very different as their portfolio is very diversified as well. Yeah, but if you're just looking at pure play data center, it could be an alternative, but it's not really a one-for-one comparison, because yeah, they have some other industrial properties as well, and yeah, so they are not 100% data center portfolio as compared to Capital DC, which is 100% data center. Yeah, so do you think should apply for Capital DC PO? Yeah, so our stance was that if you basically, if you want to hold Capital DC REIT, or rather if you are still holding and you are entitled to the Capital DC REIT PO, and if you don't take on the PO, you'll definitely be diluted even more, and you'll basically be negatively affected even more. Yeah, so if you are a unit holder, definitely you should take on this PO. Yeah, but our general call, like Paul mentioned earlier, is to sell. But that is if that is before the entitlement or PO. But if you want to hold, definitely you have to subscribe to the PO. Uh, yeah, I think that's all. There's one question on Avagra takeover. Not sure whether anyone comment on that. If not, I think most of the questions are already answered. Let's... Oh, yeah, Paul, there's one question on why Thai baht is rising. Not sure whether you saw that question before you joined.
Oh, okay. Yeah, thanks.
Yeah.
Thanks for that, Darren. The Thai baht, no, I think there's not really nothing, no new news recently, but I think the two things going for Thai baht is number one, the valuation is really cheap. I mean, like 12 times PE now, which is probably like all-time low in terms of valuation, lower than pandemic. And the other thing going for it is that I think that probably a bit more optimism that the Thailand, because they already announced one batch of cash handouts, but these are for the older people. But I'm not saying I'm young, but I mean this is for the elderly. But the other thing is there's going to be more cash handouts, so there could be a bit more optimism. And thirdly, is I think the consumer spending has bottomed out both in Thailand and also in Vietnam. So the growth rate has bottomed out because last 1-2 years has been exceptionally weak because export sector in Vietnam was slow, and then tourism now is coming back. So things are improving marginally. So the worst is over. It's just the directionally how strong that one is subject to debate. But yeah, I think that's some of the reasons why that is moving. And there are other catalysts. Now, maybe if you assume BeerCo could happen, so there's also upside optionality if the BeerCo IPO can happen or strategic sale. So I think the risk reward for that is positive. Just that the timing of that can't really say. So I think these are some of the yeah. Sorry, I think I got locked up for a while. Yeah. Let me move on to the next one. Paul, HG Metal has rights issue going on. Is it worth to pick them up? But the offer is close to, yeah. So HG Metal share price now is 265. The rights issue I just saw is like 266. So I mean, obviously myself just buy from the market. No? But I think just to give a side note, so HG Metal has a new shareholder. The shareholder is the same shareholder as BRC Asia. So I think this is probably one way for the new shareholder to probably raise their stake in HG Metal. But I think if you're a minority shareholder, I think no point to do the rights issue. I mean, just buy from the market. Since the difference is hardly anything, it's almost can even get it cheaper now if you queue. Yeah, like 266 versus the rights issue versus 265. Yeah. What's the implications to stocks if the long-term treasury yield is trending up? Is a 10-year treasury considered as long-term or medium-term? Yeah. So, 10-year treasury is usually considered. It will have a. Sorry. Yeah. I think my internet. Yeah. Just let me try and switch my internet. Yeah. Yeah. I'm so sorry if my internet connection is poor. So what's the implication of the higher treasury yields? So for higher treasury yields, it's definitely negative for stocks. It's going to be going to pull down. You're going to pull down the valuations. So think of it, if the equity market long-term returns of a equity market is 7%, and your treasury yield is 5%, I mean, it makes you wonder, why do I want to take an equity risk, right? Because I'm getting 5%, which is like almost 70-80% return on equities that is risk-free. But I don't think this will be an issue right now. So the equity market isn't really too troubled by the rise in bond yields, because it has been orderly, it has been gradual. Unless you get some sudden spike, then I think that could derail. I think if you look at the US market for 2025, the expectations are positive, because at the minimum there's going to be a corporate tax cut, and that can push earnings growth alone by 15-16% for the US markets. So earnings growth just by cutting taxes. So I think that doesn't bother the market, but in general that will be an issue for the stock market if interest rates or the treasury yields that you mentioned continues to climb. But if it's an orderly climb, I don't think the market is going to be too bothered by it, unless there's a sudden spike. If you see any auction, because the treasury does have almost every day an auction for treasury. So if suddenly you see interest rates spike, then I think market might get a bit more worried, because it also means that the Federal Reserve has no control over the interest rates. So if you imagine the Federal Reserve cut rates, but the bond yields keep rising, it means that the Federal Reserve cannot control interest rates. They cannot cut them, because even if they cut, the bond markets keep on rising. So I think that situation hasn't arrived, but I think it's just something to monitor. In your report, your Yoma strategy, you mentioned the current book value is 20. Do you refer to strategic or Yoma? Yeah, we normally Yoma strategic. Sorry, I'm not sure. Maybe my report was a bit confusing, so apologies. It's normally we talk about the holding company, because they do not separate the valuations of Yoma Central. It's always Yoma Strategic, the listed company. Any thoughts on the Fed cut for December? Any impact? Yeah. We think there'll be one more cut. Again, it's a toss-up. Really flip of a coin now, whether there'll be a rate cut or not. But with Trump there, everyone thinks because of Trump there won't be cuts. But I think there will still be cuts in 2025. At least three cuts or maybe 4 cuts. Because even though all these tariffs that you see right now won't actually impact US inflation, maybe only in end 2025. And even if you do a corporate tax cut, fiscal spending, all this will only be effective in 2026. Although the market will respond by 2025. But so I think the Fed has already clearly mentioned they won't preempt, they won't make any interest rate decisions before Donald Trump policies. So it doesn't mean that because Donald Trump announced tariffs, then the Fed say we won't cut rates. So I think they kind of clearly said that. And no, Donald Trump is always wants the Fed to cut rates. So yeah. So I think directionally, I think you should expect more interest rate cuts are coming out from the Fed. That's that on paper right now. December is still a toss-up. Your view on Bellstar and the new business? Yeah, I can give you the view next week. So we are, I mean, off the record, I guess we are kind of meeting them. So we'll get back to you on what we think of the business for Bellstar. Yeah. because due to so many requests from people, so we were lucky that the management was willing to kind of meet us. Hi, please comment on Yang Zhejiang Shipping and Centurion. So Yang Zhejiang Shipping, we are a bit more cautious. I'll leave Centurion to Yigban. So for Yang Zhejiang Shipping, we are a bit cautious because container rates are coming down. The whole ordering of containers, I think, is really slowing down. The one they're relying now is all tankers, and that even they mentioned that could be peaking soon. So we're a bit more cautious on Yang Zhejiang Shipping. But anyway, I'll leave to Yigban for Centurion. I'm not so sure. I think I'm not so sure. It could be. I think because in steel you are either doing steel rebar or you're doing steel plates for shipping and also. So I think Cosmo could be more shipping for plates. If I'm not mistaken, I'll leave it to Yigban. But HG Metal is a bit more like BRC, so I'll leave that to Yigban. Sorry, TA for the 3 local banks. Yeah, I apologize. Zane is not in today. He's still on reservist, so maybe next week. So apologize. There's no technical analysis today. Yeah. So one last one for Mr. HK Chan. Is it timely to buy long-term US bonds in view that the long-term bond yield is coming down? Yeah. For us, we are. I think as a house view, we are still a bit cautious on the bond yields. Maybe in the near term, probably the yields can come down, but mid-term, we're a bit more cautious because we're just worried that under Donald Trump, the fiscal deficit is going to explode. Yeah, it's just going to spike up. Yeah, we actually thought European bonds would be better because we think there's a more pressure for bond yields to come down in Europe because thematically, Europe growth is slowing down. Europe is basically being squeezed, by the digital US, because Europe missed the whole digital wave. They never have any internet companies, and then now they're being squeezed by all these Chinese engineering companies. So we think growth in the Europe will slow faster, and then they will probably have to cut interest rates more than US. And at the same time, there could be this Ukraine resolution that could help the European currency. So for us, we actually prefer European bonds, actually. Yeah. Okay, I'll hand it over to Yigban. Yeah. Sorry for the.
Thanks, Paul. Yep, I can take the questions on Centurion. So the question is, please comment on Centurion. Yeah. So for their latest third quarter results is quite positive. Because they show signs of increasing profitability. For example, their interest cover ratio has risen 32% year on year. And interest cover ratio is basically EBITDA divided by interest expense. So you can see it both ways. It's either their EBITDA has been rising or it's because their interest expense has been dropping. And this, I think previously we have also reported that we also expect interest expense to drop because of the falling interest rates. So we think that this is a positive sign for Centurion's results going forward. And they also have a series of portfolio growth pipelines. For example, 500 worker accommodation bids in Hong Kong. They are going to expand over there by the end of this year. They have the worker accommodations in Singapore, as mentioned just now, the 1.6K bids. And for student accommodations, there's 150 student accommodation bids operational from September this year. So you start. The revenue will be taken into account for FY24, and they also enter into a new segment, which is the build to rent. So this segment is basically a master lease kind of new business model that they are going for, which is a more asset-like strategy. Because for this master lease kind of business model, they are just renting out the units, and then they are leasing out the units to young professionals in the Xiamen city. So the young professionals will go to Xiamen city in China and just rent out all these apartments from Centurion. Yeah, so this is a new segment that they are testing out, but they have not released any financials on it. So we are also looking out on this segment itself. Yeah, so for Centurion itself, we think that overall, there's some growth catalysts going forward. For example, as mentioned just now, the Singapore PBWA, and how we think that they can charge higher rental rates for the dorms in the east, because the dorms, there's lesser supply of dorms in the east, so we think that they can charge higher rates. However, we do see some headwinds for Centurion because, for example, the DRC, as mentioned just now, the dependency ratio has fallen because of MOM stipulations. So we think that the demand for worker accoms will drop, and hence we think that the rental rates for Singapore will also moderate going forward into FY25. And another headwind we see is the dormitory transition scheme, in which they have to meet the interim standards by 2030. So we think that the lesser supply of beds mean that they can take in slightly lesser revenue from these beds. Yeah. So yeah, hope that answers your question on Centurion. There's one question on is HG Metal in similar business with CosmoSteel? Yep. Sorry, I'm not very familiar with HG Metal, but from what I read, they are also in the steel business, and I think if I compare CosmoSteel with BRC Asia, right, the main difference between CosmoSteel and BRC Asia is that CosmoSteel won't be involved in the upcoming Terminal 5 and IR construction projects, because they have mentioned that the construction's pricing for steel is much better. I think companies like BRC Metal and maybe HG Metal, they price their steel much more competitively compared to CosmoSteel. And so I feel that this is the main difference between HG Metal and CosmoSteel. And so what CosmoSteel does is that they supply steel pipes, tubings for energy companies in the energy sector. For example, all these tubings, right, will be used to transport the oil and gases to the drilling sites of these energy companies. Yeah, so this is the main customers of CosmoSteel. Yeah, hope that answers your question. I think there's a question on WeHer and Centurion. Is WeHer alternative pick for Centurion in view the latter share price already run a lot? That means do I think that WeHer is a better pick because Centurion's share price has already run a lot? Yeah. Okay, we haven't officially covered WeHer yet. Currently our call for Centurion is accumulate, and there's around like a 10% upside in the share price for Centurion right now. If you were to ask me whether WeHer is an alternative pick for Centurion, I personally feel that WeHer has a much larger growth runway as compared to Centurion, because I feel that Centurion's business in terms of the just now when I talk about the demand dynamics for the worker accommodation bids, we feel that the rental rates will moderate, and also management also guided that revenue growth in worker accommodations for Centurion won't be that exciting going forward. Yeah. So however for WeHer, we feel that there's a lot of growth runway, because next year they will have additional 11,000 beds for worker accommodations, and this is on top of their existing 16,000 beds. So there's like close to half more room for growth in terms of the worker accommodation sector. And WeHer is also the main part of WeHer's revenue segment is from building construction itself. Yeah, so we feel that going forward with construction, with a lot of construction growth catalysts in Singapore, we think that there'll be a big runway for WeHer as compared to Centurion. Yeah, thanks. I think I will hand over the time to my other colleagues.
Yeah, okay, thanks. Let's try to answer and try to wrap this up. Why is HSBC price and dividend going up while their Hong Kong banks like BOC are weak? Does the Hong Kong SDR gain the same dividends as in Yeah, we don't cover HSBC, but the only difference I guess is that HSBC is not only in Hong Kong or China, they also have a UK business. But again, apologies, we don't cover Hong Kong stocks out of here, and whatever you get should also be the same for SDR, because SDR is technically you still own it, just that the depository is a different depository. Yeah. Okay, should we stay away from Chinese equities in view of upcoming tariffs? So our view is that in the near term, probably stay away first, because we think we're not sure what Trump's going to say on the January 20th. So again, this is going to be very highly volatile. You know, your it's like a two-legged tail risk. You're not really sure what he's going to say every day. But for us, we just think that there is a bottoming out process for the Chinese equities. I think we clearly saw that the Chinese authorities are willing to come in at a certain level for Chinese equities. So, and we just wanted to just highlight that there can always be a deal for Chinese equities, and currently the difference thing is that the tariffs are not just on China, it's on everyone else. So everyone else is almost like on the same playing field with China right now. So that was our main point. Yeah. Genting outlook, poor results and competition renewal only 2 years. Yeah, we think it's going to be weak for Genting. I mean, they don't invite us for their calls, but when you see one quarter week, like you highlighted, it usually runs in the next few quarters. When there's a consumer spending or entertainment or any in general, when there's a weak quarter, it usually continues. It doesn't mean that one quarter weak, then the next quarter everybody decide they want to go and gamble in Genting. So it's probably a reflection of the weaker consumer spending and so forth. We were surprised. We thought the mass market will hold for them, but now it's not only just the mass market, but it's also the VIP market. The VIP, we thought the VIP was already done deal, going to be weak, but we didn't know the mass was also just as bad. So although there's a bit of luck factor there, but again, for us, we are negative on Genting. Under Trump 1.0, US dollar depreciate, Fed funds rate decrease, all price decrease. Would similar under Trump 2.0. Very hard to generalize, no? Because at that time there wasn't inflation, and at that time the US didn't have such a huge what they call it, such a huge debt to GDP, such a huge deficit. So things are a bit more different. So even if you want to stimulate, it may not be able to stimulate that much. For US dollar, I think it will still appreciate in a very near term, because the rate differential, the growth differential of the US compared to the rest of the world is still better than the rest of the world. Because currency moves on either largely, like in general, either economic or interest rate differential. So these are all still in favor of the US. And also oil price, I don't think Trump can do anything about oil price. I think oil price is not determined by him, it's determined by so many other factors. So the thing that could hurt is what he does to Iran, because Iran produces 4 million barrels. So even if you take out Iran, there's still some spare capacity from the OPEC. I think they got like Saudi Arabia alone got 2 million plus, then the non-OPEC. So I think you probably can get some knee-jerk reaction from oil price. But I don't think yeah, because if he pushes down oil price, also that was not I think he is also going to hurt some of his vote base. So but we think oil price might be a bit big from in the near term, because the whole supply situation is coming. I think OPEC is going to bring on some oil supply, I think next year. I think, yeah. Sorry, I don't have the figures offhand. Yeah. Sorry, it's just that we can't replicate everything. I think it's very hard for us to generalize and say that 1.0 and 2.0 will be the same. Yeah. Just a reminder that next week on the 9th will be the last webinar that we have. And note, if you feel free, do dial into our Marco Polo Corporate Insights for tomorrow. Yeah. Thanks everyone, and take care. Have a good week. Have a good week ahead, everybody. Thank you.